Hi everybody and welcome back to Money, Mortgage, Moving Out. I'm Sam and this is Pip.
Hi!
And today we're going to be talking about a little bit of debt and loans.
Debt is usually a dirty word, so much so that the financial services industry have rebranded it as credit.
Although a lot of people are up to their eyeballs in debt, it's not all the same.
When looking at debt, not all debt is a bad thing. Sometimes borrowing money is a good thing. For instance, buying a car on finance or getting a new phone contract to help your credit score.
In order to have a good relationship with money and to avoid wasting it, it's important to understand how to borrow well.
Getting on top of your debt is vital before starting any kind of budget or opening a savings account.
There's no point setting any money aside if you're still paying hundreds of pounds in debts or any interests on overdrafts or things like that.
There is a great benefit to clearing your debt as quickly as possible, as it will reduce the amount of money that you have to pay in the end.
So let's start with student loans. Student loans are most likely the second biggest debt after a mortgage. But really, this is the debt you should worry least about. With a student loan debt, you will never need bailing out because you only pay it back if you're doing well enough independently to pay it back. This is not affected by your parents' financial situation.
For anyone who has been to uni since 1998, unless you've moved abroad and not told the SSC, there will be no bailiffs involved. Simply, if you cannot pay your student loan repayments, you don't pay them. For example, you can borrow £50,000 and repay £0 if you're on a minimum wage job until your 50s. If you compare that to banks and payday loans, they don't care how much you earn, you owe them money regardless.
The richest graduates who can cover more of the repayments will end up paying the most. This is nothing to do with their financial background. The easiest way to think of your student loan debt is as a tax that you only start paying once you graduate and you start earning enough. Like tax, your student loan will reduce the amount of money that you have in your account, therefore reducing the amount of money you can spend on other things. This will also impact how much you have to borrow for a mortgage.
But it will not spiral out of control to the point where you can't pay it. Those who graduated before 2012 will stop paying much sooner than those who started after 2012. This is because their student loan was much less. However, the amount you have to earn before you start paying back the student loan is much lower for those who graduated before 2012.
For students who started after 2012, the tuition fee went up to £9,000. You'll start repaying your student loan only when you start earning £25,000 a year, or above these prices, true to April 2018-19. Starting the April after you graduate, that £25,000 threshold will gradually rise each year, with RPI, which is a measure of inflation on average earnings. Your repayment is a fixed amount like a tax, so 9% of everything you earn over £25,000, regardless on interest rates charged on your loans. That means if you earn £26,000 a year, you'll pay back £90 a year, £1,000 above the threshold. So 9% of 1,000 is £90.
If you earn £35,000, you'll pay back £900 a year. £10,000 above the threshold, 9% of 10,000 is 900. You can see why higher earners pay off more of their student loan, as that 9% is much larger. You also see how much you need to earn to make a substantial dent in £50,000, especially as your debt is completely written off 30 years from the April after you graduate. Interest is charged on your original loan. Whilst you're studying, this amounts to 3% plus RPI. It then changes if you're earning under the threshold, so it's pegged to RPI. However large your loan becomes, you'll still only pay 9% above the threshold. That's why if you're earning a lot of money, you don't need to worry too much about the interest charged on your student loan, because you only pay off what you can within the 30 years.
When thinking as a post-2012 student, should I pay off my loan early? Martin Lewis suggests that only the graduates that land a graduate job that earns over £40,000 a year and have the likelihood of getting a raise should consider it to avoid mounting interest. So the Money Saving Expert website actually has a calculator where you can play around with the sliders to see how likely you are to actually pay it off in 30 years.
For those on Plan 1 student loans who started between 1998 and 2011, and for Scottish and students from Northern Ireland who started after 2012, you will start to repay your student loan when you're earning over £18,330 a year. This is true of 2018 to 2019. That threshold usually rises each year. Your repayment is also fixed to 9% over that £18,330 threshold. So if you earn £20,000, you will pay £150.30 a year, 9% of 1,670, which is the difference between 20,000 and 18,330. The interest rates are currently set at 1.5%. The interest is rated at either the Bank of England base rate plus 1% or RPI, whichever is lowest.
When looking at repaying Plan 1 loans, it's less obvious because most graduates will eventually clear it. Therefore, you do have a reason to start paying it off early, as your loan is not totally interest-free. However, do not pay off your student loan if you have any other outstanding debts with higher interest rates and potential bailiffs.
Next, let's talk about personal loans.
If you are in need of some money for a new car, or a holiday, or even a wedding, you might need to take out a personal loan.
These are unsecured loans, which means they are not tied to anything, unlike a mortgage.
A mortgage is a secured loan against your property, and if you can't pay the secured loan, the bank can take the property off you and sell it and use it as compensation for the money that you owe.
Whereas if you can't pay off a personal loan, this may be passed on to a debt collector, which is not good.
A debt collector can only request that you pay debt, whilst the interest rates pile up and you have to declare bankruptcy.
Whereas a bailiff can come to your property and take your personal belongings. However, they can only collect debts relating to TV licenses and parking fines.
A personal loan is usually a lot more expensive than the best credit cards that are out there, but you can borrow more with a personal loan.
With a loan, you'll usually pay a fixed amount plus interest over a fixed period of time.
So it makes sense to pay it back quicker so the interest does not build up.
There are lots of different types of personal loans, and they can range from £1,000 up to £25,000 and can be spread over 1 year up to 7 years.
They may be labelled differently, but they are the same type of product.
You need to watch out for fees if you repay your loan early.
And you may be charged fees for setting up your loan in the first place. Another type of loan is a payday loan.
The only reason that payday loans are allowed in the UK is otherwise people might turn to loan sharks.
So therefore, payday lenders are to be avoided at all costs.
Especially if you're trying to get a mortgage.
Payday loans are very expensive if you cannot pay them back in time.
They are just a short solution and they're meant to just tide you over until your next payday. Hence why they offer smaller amounts of £50 to £1,000.
you will be charged a large fee rather than an interest rate.
They are not designed to be paid off over a long period of time.
It will be harder to get a mortgage if you've taken out a payday loan, even if you paid it back on time.
Payday loan prices are now applied by the government as they are considered to be debilitating.
That means you will not have to pay off more than double of what you borrowed, but it's still going to be a really big fee.
The last loan we're going to be looking at is peer-to-peer loans.
These are a loan that allows individual savers to lend to individual borrowers. Borrowers pay lower interest rates, while savers get a higher interest rate.
These loans may be more flexible, as you may be able to choose your repayment scheme and will not be charged for early repayment fees.
If you are a saver, then there is a potential risk to losing your money, but you have nothing to worry about if you are borrowing.
We hope that you have found this episode informative and it has helped you to understand debt and any loans that you may have a little bit better.
As we have said, some debt can be positive, so don't you stress about it if you are in debt.
Think logically and try your best to clear your debt before you start any kinds of savings.
Making and sticking to a budget is a great way to sort out your debts. But if you want any help on that, if you go to our budgeting episode and see what we've got there, it can be very helpful.
We have split this debt episode over 2 parts as there is so much that we need to cover.
We'll be posting our second part of debt on Sunday at 5 PM, as always, if you want to check that out next week.
But for now, thank you so much for watching this video. We really appreciate your support.
We would be extremely grateful if you liked the video and if you subscribed to the channel. It'll help us out a lot. And don't forget to follow at Money Mortgage Moving Out on Instagram if you want all new updates on videos and when we're going to be posting them and what they're going to be about.
And also, we've set up a TikTok where we'll be showing you short little snippets of our videos, so make sure you head over to TikTok at Money Mortgage Moving Out and check out our videos.
We'll see you next time.
Much love!